Before the financial crisis, the size of the Fed's balance sheet was a function of demand for our liabilities, principally currency and to a far less extent reserves. Quantitative easing comes along. We hit the zero lower bound. The Fed buys a lot of assets. That was about buying assets. And the size of the balance sheet as a percent of GDP went from 6% to 25%. And that was really driven by a desire to buy longer-term credit assets, or rather federal government debt, and drive down longer-term interest rates. So now we're normalizing the balance sheet, and normalizing it really means going back to a situation where the size of the balance sheet is driven by demand for our liabilities, which has evolved. So currency and reserves mainly. So what's happened is demand for currency has grown. Outstanding has grown much faster than the economy, and demand for reserves is now much higher than it was because really we require banks to hold very high levels of high-quality liquid assets, and they choose to hold reserves. So we can't go back to that very small balance sheet. So what we think is that the committee's been working on this carefully for the last 3 FOMC meetings and devising a plan. We're close to agreeing on a plan which would would sort of light the way to the end of the process.
And do you plan to communicate that?
Very much.
That plan?
Yes, we do. When it's agreed, we've found it's good to be very careful with the balance sheet.
But your reference point was about $1 trillion in bank reserves at the Fed would be the reference point for when you sort of end the reduction of the balance sheet.
So there's tremendous.
Do you have a time frame on that?
Yes. There's a lot of uncertainty around the actual level. What I did was I cited public estimates and said those appear reasonable. We actually don't know what the equilibrium demand will be. We're going to have to find it over time. Okay. And my guess is we'll be announcing something fairly soon.